Hello guys, welcome back again. Microsoft is obviously a company that I would love to own, and I'm pretty sure a lot of you would as well. The thing is, it used to be expensive. Now it is down 25% from its 1 year high, potentially giving an interesting entry point. It doesn't mean that it is a buy yet though. And so in this video we're going to examine whether it is actually a buy or whether we should be waiting for a potentially better price if that ever happens. Because remember that a good investment is not just about the company, it's about how much we pay to get it, to get the stock of that company. The company Microsoft is almost a $2 trillion market cap company, absolutely massive here, as you can understand, and has been doing great over the years. If you take a look at the max chart here, you will see that it has been a massive high flyer, and over the long run, you will see that it has gone to the sky really, and it has been going down a little bit lately. But take a look at this insane growth here. If you bought it early, you made a fortune in this one, an absolute fortune. Now, what is currently happening with the company, with the stock? Let's first take a little bit of a look at the stock news. Is there anything new happening here? So it looks like there is a deal with Meta here. This is interesting to notice here. It is a very interesting article. You will see that Microsoft shares are flat despite the new deal with Meta. I guess anything that has to do with Facebook kind of keeps things flat these days. But the company signed up Meta Platforms to become one of Meta's strategic cloud providers for their Azure cloud business. Very, very interesting here. So let's go back and examine what is happening here with Microsoft in terms of their stock, pretty much, and their financials. You will see that the company has a P/E ratio of 27.4 here, which is relatively high, as you can understand, although this is a big tech company and it could have a little bit of a higher P/E ratio and still be okay in terms of valuation. Now, the price to free cash flow ratio is sitting at 35, which is more elevated than the price to earnings ratio. As you know, this is a more important number than the price to earnings ratio. We will examine the details, but it does look a little bit elevated here. Outstanding shares of 7.5 billion. This is a very large amount of shares, but it doesn't make a difference. What makes a difference is the company buying back shares, and we want them to keep on doing that. But this is a green, it is a check mark. Now, the free cash flow that the company generated would take about 3.4 years, last year's free cash flow, to pay back all the total liabilities that the company has, meaning it is a very solvent company. And it's still growing their revenue at a very, very nice rate here, almost 87%. Great growth for a company like Microsoft, which is a giant. Net income also increasing tremendously, free cash flow tremendously as well, and total equity, same thing. Now, the debt to equity ratio is rather low, and it looks like Microsoft is not really so much into getting debt, and still the return on equity is very high, 47%. Net income margin of 37.6. You'll have to see that this is a software company making tons of money because of the margins as well. Margins are very, very high. And a dividend yield of near 1%, which is 32% of its free cash flow. That's the payout ratio. If we take a look at the dividends module, which I always like to do just to see the history of increases in terms of the dividend price, you will see that the effective dividend yield is 0.94 today, and the dividend yield in the last 12 months has been 0.92, about the same. But it has been increasing over the years, and over here you can see the full breakdown of adjusted dividends, and you can see it in the chart as well. Let's go back and take a little bit of a closer look at the rest of the things about this company. And pretty much, of course, you can find a price to book value that is expensive. That is okay for a software company. It's not a big deal at all. Software companies tend to have high price to book values, and it doesn't really make a difference. These companies are not really about the book value. They're about the growth that they can generate and the insane margins. They are a different story. They are not like a bank, for example, in which case a price to book value would be much more important. Income statement here, again, we know that the company has been growing like like crazy here, 90 billion to 168, absolutely insane. And look at this net income from 21 to 61, 3 times as much. This is amazing numbers here, as you can understand. And the balance sheet of the company has been also growing, 72.3 billion to 142 billion, doubling pretty much their equity over the years, which is tremendous, as you can see. And take a look at this retained earnings, 2.6 actually, 2.6 billion back in 2017, and where was it? I lost it. Yes, and 57.6.06 right now. This is tremendous. This retained earnings account is basically the accumulation of net income over the years. And as you'll see, Microsoft is becoming sort of like a cash hoarder here. They are making tons here in retained earnings, making tons every year. This is amazing for the company, bettering their balance sheet tremendously every year. And 76 billion is their current cash flow provided by operating activities. Quite some stock-based compensation, of course, and a lot of depreciation and amortization too. This is a massive company, of course. You would expect things of that sort. And purchasing tons of investments here. Look at this value: 77 billion, 62 billion, and also investing in PPE also makes sense. Paying about 16.52 billion actually in dividends, a massive amount, of course, but they can handle it because they are making 56 in free cash flow. That's what they did last year. And they also have 14.22 billion in cash. In terms of financing, they are basically paying back, actually they're mostly purchasing common stock, so they're buying back shares right now, which makes a ton of sense, of course. And they're paying back debt and some dividends, of course. Now, they are buying back shares, but are they that cheap? I mean, it does make sense potentially because the stock price is going down, but are they really that cheap? Does it actually make sense for us to buy? Now, the revenue growth has been, look at this, 5, 22, 14, 13, 17. So, we will go with something a little bit lower, but still something that's fair. 8, 10, and 12, I think, is very fair for the next 5 years. The net income margins that the company generates have been a little bit all over the place in the past few years, but right now they are kind of balancing themselves out at 31, 30, 36. 36 is actually their highest right now, but I'm going to go a little bit lower, 28, 30, and 32. This may be actually a little bit too low here in terms of the high estimates at least. The free cash flow margin, at least 3 years are way, way more normal. And I'm going to go with 90, 95, and 100, and an annual return of 13%, which is typical. You will see when I hit calculate that the current price is expensive for buying right now, and this is the big problem with a company like Microsoft. It's an amazing company, but I just can't buy right now because it is expensive, very, very expensive. It's almost double as much as I would as I would want it to buy it at. So 130, maybe 120 could be a potentially nice entry point, but the stock price right now is double that and then some, so 262. And even though I love Microsoft in terms of what they are doing, they have been growing tremendously well. Their numbers are amazing. They're hoarding cash. They're pretty much doing great. I just can't see myself buying at this number because I'm overpaying if I do so, and so I have to avoid this one and wait maybe for a correction if that ever happens, or for Microsoft to better their numbers and still keep at a normal price so that I can actually buy a company that aligns more with its financials, that the stock aligns more with its financials and it's cheaper. So yeah, great company. I can't see myself buying right now. Thanks for watching. Please let me know what you think about Microsoft. It's obviously a fantastic company, but let me know if you're buying it or if you have bought it. And if you have bought it at an earlier price, which would have been amazing, maybe some years ago where it was much, much lower, would make a ton of sense. But thank you for watching the video. Please remember to leave a like, that helps a lot, and subscribe if you're not a subscriber. And remember, you can always become a Patreon and get access to this too, unlimited access. You can find links in the description box below, and please join our Discord channel if you are interested in our discussions. We're having tons of nice discussions every day about the economy and stocks, investing and everything. We'd love to have you there. And I'll see you in the next video, guys. Take a look at this one also that I made earlier, and it's about Best Buy. And see you in the next one. Bye-bye.